Over the last 12 months, Netweb Technologies has surged 160%. They have established themselves as India's premier manufacturer of high-end computing solutions and supercomputing infrastructure. Their operational record is strong. They deployed Aerowatt, India's fastest supercomputer, and they currently lead the domestic market in private cloud installations. This chart tracks Netweb's revenue specifically from AI systems and enterprise workstations. This single segment grew 160% year-over-year. That AI surge is the foundation for management's projected 45% compound annual growth rate. They expect this momentum to carry straight through fiscal 2027. Netweb is executing with precision, capturing the domestic sovereign AI hardware market exactly as national demand reaches a fever pitch. But that precision is already priced in. For investors looking to enter now, the acquisition cost is historically high. To access that 45% growth, you have to pay a price-to-earnings ratio of 124 times and a price-to-book ratio of 34. A 34 times price-to-book ratio means you are paying a heavy premium for future earnings rather than the company's current physical assets or cash on hand. This is the central trade-off. Are you securing a strategic entry into sovereign AI, or are you simply paying tomorrow's peak prices for today's growth? Buying Netweb at these levels provides direct exposure to a booming sector, but it leaves the investor with zero margin of safety. To see how unusual this valuation is, we have to look at the rest of the Indian IT hardware and electronics sector. The disparity is stark. While Netweb sits at a 124 PE, a peer like Control Print trades at roughly 8, with a price-to-book of 2.1. Even for Netweb, this is a deviation. In just 1 year, their price-to-book expanded from 16 up to 34. There is a logical basis for this premium. Netweb isn't an assembler. They are a specialist in high-end computing, a field with intense technical barriers. They defend this position with intensive R&D, consistently reinvesting about 4% of their total sales into product development. This focus has allowed them to displace foreign manufacturers in niche, bespoke computing configurations that standard servers can't handle. Their market position is unique, but the speed of this valuation expansion leaves the stock vulnerable to a sharp correction if peer competition begins to catch up. Operationally, Netweb just secured 21.8 billion rupees in strategic AI orders aimed at building out India's sovereign compute capabilities. These contracts create a substantial multi-year pipeline for government bodies and hyperscalers, filling the order book through fiscal 2027. However, there is a catch in the fine points. These high-volume strategic orders actually carry lower profit margins than the company's regular business. This chart tracks their gross margin over the next few years. Notice the trend line. Management expects margins on these strategic orders to be 150 to 200 basis points lower, meaning surging revenue won't translate to bottom-line profit as efficiently. Management is targeting overall EBITDA margins of 13 to 14%, but with these thinner buffers, any execution delay or supply chain hiccup could put that target at risk. When a stock is priced for perfection, even a minor margin miss on a large order can trigger a sudden sell-off. One defensive shield Netweb has is its balance sheet stability, something rare in such capital-intensive industries. Since 2019, they have aggressively cut their leverage, dropping their debt-to-equity ratio from 1.12 to just 0.01 today. This gives them total operational freedom. Unweighed by interest payments, they generate a return on capital employed of 33%, using their shareholders' equity highly efficiently. But there is a trade-off. With zero debt to worry about, the stock's valuation is driven entirely by equity sentiment, making it hypersensitive to the actions of its promoters. Because growth isn't being funded by loans, any shift in promoter holdings or insider selling would likely damage investor confidence much more than it would for a typical company. Bankruptcy risk is virtually non-existent, but that shifts the entire risk profile onto market psychology. The price relies completely on continued trust in management's execution. Deciding whether to invest in Netweb isn't a simple yes or no. It's about matching the stock to one of two different investment strategies. Let's start with value and growth at a reasonable price investors. A price-to-book of 34 and a PE of 124 violates traditional margin of safety principles. These investors should wait for a contraction or find reasonably priced peers. But for aggressive growth investors seeking a pure AI play, the math changes. For you, Netweb is the primary domestic option. They lead the sovereign AI sector and have no debt-related risks to derail their expansion. However, you have to be prepared for the psychological cost. Expect substantial price swings the moment there is even a slight miss in quarterly earnings. In the end, you aren't paying for what Netweb is worth today. You are paying a steep premium for a front-row seat